Today we're touching on Murabaha, and Mushawama. Section 6. Introduction. One of the major activities of Islamic banks is trading in commodities in conformity with Sharia rules. Investment in the real business sector generates profits for Islamic banks. Clients need credit and banks sell goods on credit. By Mujah. Different bimutual contracts are Mushawama. Agents bargain on price, agree, sale is executed, and delivery of goods is deferred payment. With Murabaha, cost plus markup, parties bargain on profit margin over the known cost price. All costs related to the acquisition of the good must be revealed to the buyer. Murabaha seemed to be a perfect alternative to conventional mode of financing. Conditions of valid buy. The parties must be mukallaf, qualified to enter a contract, free mutual consent between the buyer and seller, offer the acceptance included a certainty of the following: place of delivery, time of payment of price, and date of delivery as well as price. Seller must be the owner or agent. Subject sale must exist in the time of sale of the object. Example, no sale of possible goods, like an unborn calf. Mabi should be well defined and should be in the ownership of the seller. One cannot sell what one does not own. Subject must be physical and constructive possession of seller. Constructive possessive equal to greater than buyer have not take possession of the good, but the ownership risk have been transferred to him. Example, a purchased car from B has not physically handed the car to A, but placed it in a garage where it is accessible to A. The risk of the car is passed on to A. He is now the constructive owner, and he can sell the third party C. Sale must be on spot and absolute. Example, on the 30th of December, we'll sell you my house. On the 3rd of January, the sale is void and there are no liabilities. It has to be absolute on spot. Conditions. Subject must be lawful and the value illicit. Subject of sale must be known and identified by the buyer. Upon purchase, the delivery must be certain and not depend on chance. Sell a cow which is stolen, which they hope to get back. The sale is void. Price is stipulated so that the buyer is sure of what exactly the details entails. By Alamana, as discussed above, Murabaha involves the sale of an object where the seller discloses the purchase price with an agreed markup. Mentioned by Imam Malik in his hadith book Muwatta, Murabaha is conducted and completed by exchanging goods and price, including a mutually agreed profit margin, then and there. Imperfect Murabaha, the buyer must be privy to the price, additional cost incurred, and the profit margin. The need for it is to protect customers with less experience in trade from tricks and injustice by greedy traders. The need for it to be specific conditions is goods to be traded must be real and tangible. Royalties, for example, cannot be traded through Murabaha. Currencies and monetary units are also not tradable under Murabaha. Original price and additional cost incurred. The prospective seller must disclose all defects and payment mode. Price one reached cannot be changed. The buyer of Murabaha has the right to an option if he considers that he has been defrauded by the seller. Example, false statement, inflating prices, or any form of illegal sale. This is, however, only valid before the buyer starts using the object. Normal Murabaha is structured on the basis of deferred payment. Murabaha cannot be undertaken for goods like gold, silver, currencies, because all monetary units are subject under the rule of Bai al-Sarf. Quran teaches Allah has made the trade lawful. Sunnah, the Prophet, peace be upon him, himself purchased a garment from a Jew and promised to pay a price to the fixed date by pledging his iron breast coat. Structures of Murbaha directed trading by bank management is ideal, where you have the bankers themselves involved in creating room for corporate corruption due to lack of expertise in trading for banking employees. Effects internal controls must be in place to prevent these practices. Banks purchase from third party for inventory purpose or upon customer request. In such transactions, banks remain liable to risk. What does it entail? The customer's request that he will buy the goods from the bank, profit margin to be taken by the bank, the sale price, which include the cost price, the payment dates. Murabaha purchase order involve a bank and a client, where the client requests from the bank the purchase of an item from third party. MPO, Murabaha purchase order, arise from the following. Commercial banks do not shop and store their goods. They do not engage in inventory. The impossibility of purchasing goods in advance for clients. Banks need to know exactly what their clients want and demand. Central bank regulations do not allow banks to trade in such manners. This is to maintain their liquidity positions and to avoid monopoly of market. Thus, Islamic banks are only allowed to purchase goods upon their customers' request. This is only binding when clients make a direct demand and take necessary commitments. It is accepted for the customer to inform the bank where to purchase the item needed. The client of the supplier should not discuss on price and make payment arrangements without the notice of the bank, violates Sharia rules. Promise to supply the acceptance of an item upon delivery to be guaranteed. Islamic banks have not been prohibited from MPO from entering into trading commodities. They can enter into such activities and create inventories. IBs which do not keep inventories can instead buy items at the request of their clients. Due to higher demand of their customer, Islamic banks can maintain inventories by engaging in trading activities, increase the bank's profit, and help clients achieve items and cheaper rates. The banks can purchase items through third party by engaging the client to get the item and possess it, while the bank do the payment directly to the supplier. Commodity remains at the risk of the financer. The seller, the client buys it at a different payment, deferred. Modern Murabaha may also involve agency relationship between the bank and third party. Modus operandi, an agreement detailing the amount of avail allocated, followed by the agreement to purchase the item by the client. An agency contract whereby the agent, client, or a third party purchase the item identified by the client on behalf of the bank. The actual Murabaha contract, where the bank takes possession of the item. Fiqh rule, where promise is not binding. Some issues must be made clear. Fulfilling promises is recommended and breaking them reproachable, but they are not mandatory and cannot be enforced in courts. The Malik school of thought believes that promises are not binding, but if a promiser causes the promisee some damages, he will be compelled to fulfill his promise. Example: a customer requests a bank purchase an item according to Murabaha contract and agrees to purchase the item on cost plus markup, and breach the contract by the client will result in loss of the bank. Thus, the type of promise must be enforced to prevent the bank from loss. It is possible for banks to obtain earnest money from clients provided that the latter will buy the item. MPO, the customer as the bank's agent, modus operandi. Um, Customer approaches the bank with a request for the purchase of an item on credit that can be legally sold. The bank appoints client as agent to purchase the item. Bank purchases the item through the client as agent. Bank makes payment to the vendor. Customer takes delivery. Behalf of the bank as agent offers the purchase is the made by customer. Bank accepts the transfer ownership to the customer upon execution of Murabaha. Customer makes deferred payment. The relationship between the agents involved is the bank to client, is principal to agent, or promisor and promisee, or buyer and seller, or seller and buyer, or creditor and debtor. The pre-promise stage, trade between bank and client must be genuine goods. No liquidity, cash financing, and Murabaha. The contract should not be linked to any previous contract or mixed with another contract, and supplier must be third party and not customer himself, his agent in business. Master Murabaha facility. The MOU where the following be met is the limit facility nature of the commodity, profit margin to be taken by the bank, payment plan, security deposit, and other relevant terms. Purchase requisition. Cost, price, and expected delivery date. Requisition will contain details of goods and the name of the supplier. Client makes purchase order through the bank to buy the item. Customer will make the undertaking that he will purchase the goods to be acquired by the bank. If client nominates a supplier, he must provide the performance bond and guarantee that he will accept the goods. Earnest money can be demanded from the customer to serve as guarantee. If a customer back out after making a formal request, banks sell goods and market to recover the cost. Payment is made directly to the supplier. Payment of funds to the client can result in misutilization of the funds. If advance payment is made to the supplier, bank can charge a higher profit margin than if it were to pay upon delivery. After the execution of sale, any rebate must be passed on to the customer and reduced at the cost of sale. On the other hand, any escalation of prices must be specified to the bank, who have the right to either accept or reject the Murabaha contract. If the goods to be supplied are different from those in the contract agreement, parties negotiate to make changes equal to or greater than mutual consent. Acquisition of title and possession of item. Banks must take possession of the item. Executing Murabaha involves taking risk. The period passing risk must be clearly defined between supplier and the bank. Murabaha in natural gas and pipes is not acceptable in Sharia. Banks must ensure the taka full of the ownership related to expenses and are paid before completion of the Murabaha, so insurance must be paid before the completion of the Murabaha. Execution of Murabaha stage offer and acceptance. A customer who doubles as an agent must have a request to purchase the bank after identifying the item. Banks accept offer and deal is over. Letter of acceptance must be clearly defined, price, delivery date, etc. A relationship between bank and client, the creditor and debtor from buyer and seller. If customer releases any defect in the item, he may seek to refund compensation of the supplier. For security purpose, bank may demand collateral from customer for timely payment. Guarantee can be in the form of the following: pledge of goods or marketable securities, mortgage charge on movable and immovable assets, and bank guarantees or personal guarantees for any mutually agreed security between parties. Sale price or some implications, credit price, legal implications, What is the argument here? Murabaha transactions by banks could involve two transactions in one. By banks could involve two transactions in one. Argument: the promise to buy is binding in Murabaha, leading to two contracts. Promise does not take the form of legal contract. It is acceptable. Difference in implications between sale contract and promise to buy contracts. Unilateral promise is a promise and cannot take a form of a contract. Avoiding buyback, known as buy al-inna, process involves double sale. The borrower of the lender sell and resell the item between them. Cash and credit comprise a loan with interest, backdoor riba. These are things to avoid in buyback, practiced in Malaysia but not permissible in the rest of the world. AAOIFI holds similar view of the majority scholars regarding its prohibition. Islamic banks should be vigilant so that the client does not sell their own items, goods to the bank. Khayyar, option to rescind the sale. Banks can rescind a sale if item is found to be faulty. Liability remains that the buyer, if he inspects the goods himself, recommended the bank to the supplier. Any lack of quantity specifications remains that the supplier leading the bank reducing sale price and the buyer having an option to rescind the contract. Today's IBs must rely on customers to identify and inspect the goods themselves to reduce risk associated with poor quality goods. Banks can also take a performance guarantee to secure against poor quality goods. Sharia compliance. In the time of executing, banks are required by Sharia to possess the good in question at the time of the Murabaha agreement. Agency contracts, where the bank is assigned the client to purchase the goods, sell it back to the bank, may be contradictory. Agency contracts must be therefore treated separately by banks, which should take the form of offer and acceptance. Conventional banking, delinquent customers reschedules this payment, usually at a higher rate interest, and Islamic banks may face deliberate delays, lack of interest, and default charges. Options for Islamic banks in such situations are equal to greater than to punishment deliberate defaulters by asking for full payment of deferred amount, and all installment may become due. Murabaha contract defaulters can also pay the charity pool in discipline. Is the same as interest? Is this the same as interest? Fatwa: the Sharia Board of Al-Baqarah, Sudan, authorizes Islamic banks to impose late fees to be taken as the bank income on the basis of profit rate actually gained by its during the period of default, as if delayed money had also earned that profit if received by the bank. Difficult to differentiate the above fatwa at times with the conventional interest. Is true. Rebates on early payment. The issue rebate income controversial. The issue of rebating controversial in Islamic banking. How about customers who wish to pay earlier? In Murabaha, such practices can render the whole contract invalid unless the contract is silent, in which case the bank may, in consultation with Sharia advisor, permit such rebate on a merit basis and not as a rule. Rollover Murabaha. Booking another Murabaha against receivables of any previous Murabaha. Client default and banks decide to add further markup amounts to it. Banks are not entitled to further markup when goods are transferred to customers. What is allowed? Rescheduling. What is prohibited? Repricing and rollover. In event of rescheduled payment, the bank cannot change anything. Possibility of new Murabaha through sale of new goods. Through shares. Um, Islamic banks purchase shares the client as agent and resell them based on Murabaha clients. Share sale is permissible under Murabaha, Sharia compliant, but Islamic banks must take extra precaution. Preferable to buy them through brokers instead of clients themselves as agents. Buyback should be avoided as much as possible. Buying a share of a sister concern of the silent. Commodity. Purchase of sale of commodities in the international market by IBs as a treasury option. London Metal Exchange, for example. Internationally used for liquidity management, modus operandi. IBs buy precious metals through brokers and resell them on the same date to a third-party broker on deferred payment. Complex system not widely accepted by many scholars and may lead to loss of credibility of an Islamic banking. Precautious in Murabaha. Face additional asset risk, fiduciary risk, legal risk, and mitigated through proper legal documentation, and Sharia compliance risk following proper AAOIFI standards, etc., may mitigate some of the risks. Proper internal controls must be in place for greater Sharia compliance. Strong Sharia advisory board. Musharaka and Mudaraba PLS modes may not be suitable for all financial needs of modern business. Due to the undesirability of modern business, other modes such as Murabaha are preferred. The facilities of sale, purchase of goods, and usufructs of such goods which are not consumed after usage. The Murabaha, to be legal, the bank must purchase the goods and sell them to the customer at a cost plus markup. Most elderly people prefer invest in trade or lease based than in PL contracts. The permissibility of credit sales is undisrupted in Sharia modes and preferable, but they can be risky. Yeah, rate, comment, subscribe.